Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Vandita Shivli. Joining me on the show today is Harshvardhan Roongta from Roongta Securities. Welcome to the show, Harshvardhan, and thank you so much for joining us today. Well, viewers, before we begin with our first query, it's very important that we take a look at the winners and losers of today. Every day, we will bring you the top funds in various categories. While it is important to stay invested for a reasonable period of time to make money, it is also very important to track fund performances. There are a large number of funds for you to choose from, and you can have the look of the funds of the day. These are the equity categories, market cap category, thematic categories, and that's over there for you. Alright, let's now take the first query. We have Sundar Ram from Hyderabad who has emailed up his query. He is 65 years old and is a long-term investor. He wishes to invest through SIP of 10,000 rupees in each mid-cap, multi-cap, large and multi-cap category, and 5,000 rupees in each small-cap and international funds. He wants our recommendation for the same. So international funds, that's quite interesting. What are you suggesting him, Harshvardhan?
So, well, Vandita, the intent, so he's very nicely formulated a query saying that I want to invest 10,000 in each of a multi-cap, a mid-cap, large and multi-cap, 5,000 in small caps and international funds. So, well, the intent of diversifying and having different kind of category of funds in a portfolio is a good idea. Just that, we'll take one step backwards when we'll say whenever you're deciding where to invest, primarily just ask yourself where do you want your money to go and get invested into. So, core portfolio, whenever a person is creating an equity portion, the core part of that should go into a large caps.
Okay.
So, which means around if the gentleman is wishing to invest about 40,000 rupees a month, so 50% of that should go into large caps. So, the idea is that core portion of your portfolio gets created with the best of the best companies in the country. The other part, the other balance 50% can be divided as per individual requirements. So, what I recommend Mr. Sundaram is that a core portion which is large caps should be 50%, multi caps could be 20%, mid and small caps put together would be 20%, and international funds and exposure of about 10%. Now, within the large cap category also, we've spoken earlier on the show as well that you should divide this into actively managed funds and passively managed. So, we will divide this into two parts. So, you can create a 40,000 rupees worth of a portfolio in the following manner. IDFC Nifty fund, invest 10,000 rupees. Axis Blue Chip fund, 10,000. So, these two are large caps. SBI Magnum Multi Cap, 8,000 rupees. HDFC Mid Cap Opportunities Fund, 8,000. And ICICI Prudential US Blue Chip Fund, 4,000 rupees. So, in this way, you would have large cap forming the core portion and the others with multi-cap, mid-caps and an international fund. The review of this portfolio can be done once in 2 years. So, the next review that you will do will be now after 2 years.
Yeah, and also, economy varies for different countries. So, that ways he can benefit from even the international funds. And you're suggesting that 10% of allocation in that category would be a good way to go.
Actually, international funds should and could form a part of an individual's portfolio for various reasons. The first is, of course, as you said, the economy of different countries function differently. So, as an investor, I'm also looking at geographical diversification. So, if I'm investing all in Indian equities, my money is entirely into India, which is not a bad thing at this juncture. Of course, you will want to be in in the Indian economy because it's the fastest growing economy across the world. But there is a small portion which I'd like to invest outside so that I get a geographical diversification with my money. The good part is if I'm investing through mutual funds, I don't need to go through the RBI permissions and all those things. I invest in Indian rupees. The money gets invested into US dollars and goes into the US economy, the one which we spoke about. Similarly, you will have different funds going into Asian economy, European, etc. But we're looking at US because that's the other economy that you'll want to invest into. So, one is you're getting a forex exposure, you're getting a dollar exposure. The third benefit is that there are many companies which are non-existent in India. So, like we take the bigger names such as a Google or a Facebook, or these are the companies that we are interacting with. The other part is that there are many other companies which are not directly using the services, but they are multinational global giants. So, when you invest via these funds, you also get exposure into those companies.
Absolutely, very, very rightly said. That was for you. We have our next caller who's on the line from us from Jabalpur, Pooja Pandey. Hello and very good afternoon, ma'am. What's your question?
Yeah, very good afternoon, everyone. My question was very simple. I just wanted to invest my FD money in mutual funds, which can get me a dividend, or a systemic withdrawal where I can invest that interest in SIPs.
All right. So what are you recommending her, Harshvardhan?
So if we understand the query correctly, she's a fixed deposit investor, investing about 5 lakhs, now moving out, and most certainly not being happy with the returns that a fixed deposit is giving.
Absolutely.
I think that's the trigger point. Or somebody has basically advised her that you can get better returns in mutual funds. So fair enough. I mean, until there it's fine.
Right.
What I'm not only able to understand is that you're investing as a lump sum in a debt fund maybe, or an equity fund, look at dividends out of it and reinvest that as an SIP. So I'm not able to just get that link correct. So what we could do, I mean, if I understand correctly, I mean, it's simple. I mean, ma'am, why don't you just simply invest this money into a liquid fund, which is, it is a non-equity exposure. So you don't have any equity exposure in a liquid fund or an ultra short-term fund. So this keeps your money into the certificate deposits, commercial papers. So this essentially is a non-equity exposure. From there, if you wish to do an SIP, that's what you said, the dividends will be invested as SIP. Instead, you could simply set up an STP, a systematic transfer plan, wherein a fixed sum of money can be transferred into an equity fund directly from there. So you don't have to go through the process of taking dividend in your hand and then reinvesting it again. So this will be a far more simpler process. Just taking one step further is that in case you want to keep this 5 lakhs as it is and reinvest only the income that or the returns that you generate on this 5 lakhs, that is also a possibility.
Yes. So I think she also had a question that whether dividend option is better or SWP. Definitely SWP is a better option over dividend.
Absolutely.
Right.
So at this juncture, yes, because dividends are taxed. I mean, there's a dividend distribution tax of 10% even on equity funds.
Right.
So you rather take the money out as an SWP, and but I'm still not able to
understand and connect the dots basically.
I am not able to comprehend this part as to why you want to get into this structure.
Right.
If you really,
looking at her objective, we can understand that she wants to create wealth. She wants to save on taxes. That's what I understand on the other side, because she's mentioned that she wants tax-free monthly returns of around 10 to 12%. So
okay, so there's again one nomenclature which is used, is that the dividends which you get in your hand is tax free.
Obviously.
Okay, because there is a dividend distribution tax paid, and so there is no tax that you have to pay on this.
Right.
Now the returns that you get in your hand are subject to market performance.
Absolutely.
So there is no guarantee on that part that you will get 10 to 12%. The idea is, many times people say that up to 10% of the investments that you've made, you assume that to be the returns and you withdraw that.
Right.
So then you set up an SWP with a 10%,
absolutely,
assuming that is the gains that you will make, and that is what you're removing.
Exactly.
So to keep things simple for you, ma'am, I understand that you've been a fixed deposit investor, so I don't want to complicate you further. I don't want you to get into the trap of some lucrative arrangements wherein you've been promised something else and you'll end up doing something else.
Right, absolutely.
Keep it simple. If you don't want to take risk with the 5 lakhs that you have, let it be in a debt fund, in a liquid fund or an ultra short term fund. From there, if you wish to park the entire money over a period of time into equities, then you set up an STP, which is a systematic transfer plan. In case you want to keep 5 lakhs as it is and only invest the returns that you generate over it, then that is a possibility as well. So leave the 5 lakhs as it is in a debt fund, and only the returns that you generate, transfer that into equity funds through a STP method.
Absolutely.
So I think that is simpler for her at this juncture.
So Pooja, does this give you some clarity?
Yes, ma'am. I'd like to ask one more question. That can you suggest us which funds are better for us to invest? Because we are new in this sector and we don't know much about them.
Okay, all right.
Okay, ma'am, my only suggestion to you at this juncture would be that first understand what you're doing. Naming schemes is very easy. It's not difficult because that's what we do every day in, day out. So I'm encouraging you. I'm refraining from giving you scheme names because I still don't know what exactly you're looking for. So I suggest that you meet a planner in person. Understand the modalities, also understand how this entire structure works, because while you are a fixed deposit investor, you get fixed returns. At the beginning of creating that deposit, you know exactly what you will get at the end of 1 year or 2 years. Even in debt funds, there is no assurance given of any kind. So I'm only refraining from one part, because I don't want you straight away go and start investing without understanding. So take some time out, meet somebody in person, discuss all that you know, and ask what are the queries that you need to know before you get to invest. because 5 lakhs is a reasonably good sum of money, and you don't really want to do something which you regret later.
And since you're a new investor, maybe you could look out for options like index funds or ETFs, because they're easy to track, you know.
Absolutely.
Like, because they're mirroring, basically they mirror the Nifty or Sensex.
Absolutely.
So that's quite easy. Let's move on to our next email. That's from Shalini, who's from New Delhi. She has emailed us 2 queries. First, her mutual fund portfolio comprises of 42% balance fund, 32.5% equity and 25.5% ELSS funds. She invested over an year ago. Now 5 lakh rupees are there in ICICI Prudential Equity and Debt Fund. Her aggregate returns are negative. She wants to know if it's worth to stay invested. That's her first question. Secondly, she wants to invest 5 lakh rupees via STP and wishes advice on how to invest and which funds to choose for the same. So these are the 2 questions, if you could help her with.
Okay, so taking the first part, which is her existing investment into the ICICI Pru Equity and Debt Fund. Well, as a scheme, it's a nice scheme. You can certainly be invested in it and you don't need to really worry about it. I understand the anxiety that you've not got, or rather your fund value as of today after 1 year is in negative. So so let's understand, last 1 year has been difficult for both debt and equity. So equities have been almost flat and debt has been there have been some new surprising developments in the debt segment as well. So it has been a difficult period for a hybrid equity fund that you're invested into. So in any case, I think this is a very normal phenomena in the short term, and over long term the expectation is that equities will be the asset class which will help you create wealth by generating returns which beat inflation, and debt will give you that kind of stability in the portfolio. So if you've got a hybrid equity fund with about a 30-35% in debt, I don't think that's a thing that you should worry about at this juncture. As I've already stated, ICICI as a fund house, ICICI Equity and Debt Fund as a scheme particularly is good. You can continue being invested in it. The second part was she wants to invest this 5 lakhs
via STP
and wants to do an STP on this.
Right.
So again, if you're investing in a hybrid scheme, I don't see a reason why would you want to do an STP out of this into an equity fund now.
Right.
Because a hybrid scheme also has about 65% minimum amount in equities which you've invested as a lump sum.
Right.
So to move this via STP into an equity scheme now is kind of illogical. I don't think you should get into that kind of structures. If you're looking to invest in equities, SIP or STP are simple methods, but your capital should then be invested into a liquid fund or a debt fund completely. Absolutely. And then move to equity. You don't invest into a balance fund and then move to 100% equity fund.
Right.
I mean, again, I don't think you should be getting into that. And in case you wish to invest a fresh amount of 5 lakhs, in that case, choose a liquid fund of a particular fund house where you can just park your money there, and from there you can do a parallel or a horizontal STP into an equity fund of that. So I think just clarify onto that point before you do anything. Whatever you have right now, don't need to do an STP out of that at least.
So all the very best with your investment, Shalini. Let's move on to our next caller, Mr. Deepak Jagani, who's on the line from Mumbai. Hello and very good afternoon, Deepak. What's your question?
Good afternoon. Actually, I've been doing SIP for last 3.5 to 4 years in Aditya Birla Sun Life Equity Fund, HDFC Balance Advantage Fund, Kotak Standard Multi-Cap Fund, and Miraya Asset. Now, I've seen that the returns what I have got is negative for last 3.5-4 years. I will be like to switching, to a dividend option, monthly dividend option, which I can opt for, where I can get the dividend every month.
Right.
Okay, and which mutual fund which they might give it from their own kitty rather than giving it from my own investment, basically.
Okay. Yeah, so his time horizon is 10 to 15 years and his investment objective is of course wealth creation, and he is looking for a CAGR of around 10 to 12%. So what are you suggesting him?
So well, Deepak, I think the schemes that you're investing in currently don't need any change. So per se you have some good performing schemes in your portfolio. The concern about having a flattish or a negative return over 3 years, again, I mean, these are very normal phenomena. I'm quite surprised as to why you don't even have a flat return. You have a negative return, which is quite surprising, but it's fine. I mean, these are very normal phenomena when you're investing into equity markets. Now, what concerns me is that you want to switch this from a growth option to a dividend option, so that you get monthly dividend, and more particularly that the dividend that is given to you is given from the kitty of the fund house and not from your own funds.
Right.
Now, that doesn't really happen. So dividend, when you in a dividend option, if there is a dividend given of say about 1 rupee per unit, then the NAV will fall by 1 rupee. So it has to come out of your own money. It cannot come out from a fund house, will not give out of their own kitty. So that's the the portfolio that has been created, and a dividend has been paid out. Now when you switch from a growth to dividend, there will be a tax implication, there will be long-term capital gains, there will be an exit load for the last 12 months installments that you've paid, because the treatment is that a growth option scheme is being redeemed and a fresh investment is being made into the dividend option. So there will be this tax implication and your exit loads as applicable. If your goal is to invest for long term and generate a return of 10 to 15%, you have to be in the growth option. You don't really need to take a dividend option, because if you're taking a dividend option, you're actually taking money out of the system.
Absolutely. This is a very important point that you're raising here, because a lot of people do this, that they want a dividend option, but they look for a return of 10 to 12% or even 15%. But with that option, it becomes really limited.
Absolutely, because you're taking money out of the system. How you're not allowing that money to grow again. So many people do this is take the dividend down and reinvest it again.
Absolutely.
So if you're anyways doing that and you don't need money on a regular basis, you're earning right now, this kind of dividend is not really helping you do anything extraordinary in your monthly expenditure.
Yeah.
So you rather let it grow. So you should continue with growth options, in my opinion, and just let it grow. The schemes that you invested are fine. Have patience. Understand markets are actually in that phase where you will see these kind of volatilities. Let 1 or 2 cycles turn round, and then you will see the returns that your portfolio will generate.
Right. And instead of dividend option, if you really need some money, you can have an SWP option over there. So that would be tax-free as well. All right. Thank you so much, Mr. Harshvardhan, for joining us today. It was really a pleasure.
My pleasure.
And viewers, that's all for this edition of the Mutual Fund Guide. That's how you save, invest and prosper with the right guidance right here on Business Television India. Thanks for watching us today.